All right, we are 10 seconds away from getting things started, and we might as well just X out of it. Go back to the main camera. I think the notification's going to come up in a second, anyways. There it is right now. Give me 2 seconds. And we are back. So, thank you. Another Sunday night. We took last week off, but thanks again to those of you who are joining us tonight for our weekly stock market live stream scan, option selling analysis recap. Looking forward to next week. One of these days I'll come up with a better name for it, but right now it's just kind of a bunch of word salad at the beginning of the stream. Like I mentioned, we took last week off, so it's been 2 weeks since we've been able to give you guys an update, and things have relatively been going pretty well. Probably best for me to put the spreadsheet up on screen before we start talking about it. Don't know if I have any other announcements, so let's just dive right into it and start talking about what we've got coming for the upcoming week and recapping last week. Petty Bourgeois cracking the seal on the Twitch chat. Welcome. And again, it's just me talking in my room for about an hour. So feel free to drop something in the chat, even if it's just saying hello. We can make this as interactive as possible. So I'm not just talking to a camera. And feel free if you guys have ideas or stocks that you want to take a look at, we could bring those up as well. Definitely meant to be a more interactive session. So let's jump into it. Last week, on paper, right, we lost $366, to which you may say, oh no, that sucks, we lost money. We never want to lose money, right? But again, what is our goal with this strategy? Our goal is long-term outperformance in the market. And the great news, quote unquote, you're like, oh, what's great about losing money? It's the fact that we lost 0.2% of our account. While the S&P 500 and NASDAQ dropped 2.67%. I'll zoom in maybe one more click here. Lost 2.67% and 3.33% respectively. So we crushed them, right? We outperformed by 2.47 and 3.13% respectively. So in the context of, again, that big goal of outperformance that we have, what does that look like? We remember that January and even the first couple weeks of February, the market was running really, really hot. And maybe we were a little bit uneasy about the fact that, yes, we were making money, but we were trailing the market. But let's take a look at where we stand now. And we've now surpassed the S&P 500 and we are closing in quickly on NASDAQ, despite the fact that if you go, and again, that's this chart right here that I'm talking about. Because if you, maybe I could do something like this. No, I can't do that. But if we look over here, we've kind of tracked our gap between the S&P 500 and NASDAQ. And the week of February 5th, even though we were profitable on the year and had a pretty respectable return, right? The S&P 500 and NASDAQ were up 7.82 and 14.72% respectively. And to that we said, yes, that's a great start to the year for the overall market. But what do we know? We know that the average return in the S&P 500 on a one-year basis is between 9 and 10%. So we know that a 7.82% and a 14.72% return, they're just not going to hold. I don't know when it's going to come back down, but we had a pretty good idea that they were going to come back down. So even though at that point we were trailing the S&P 500 and NASDAQ by 3.14 and 10.04% respectively, we're now in a position where, 3.5 right here, this is cheating, this counts next week, but we're in a position where as of last Friday, we're outperforming the S&P 500 now, despite the fact that it's had a very, very good start to the year. And we've significantly closed that gap on NASDAQ. As you can see, if we get the profit that we expect we may get for next week, we'll extend that gap. But let's talk a little bit about last week and talk about how we were able to, weather the storm a little bit, right? Because we'll remember in 2022, our performance at the first half of the year looked like a really, really bad EKG. Jules, if you're on right now, maybe shout out to you. If we take a look here, we dropped 20%, went up 10%, down, up, down, up. Yes, there were these great green weeks, but there were also these big red weeks. So the idea that we wanted to implement, we didn't really start implementing until June or July of last year, is, hey, let's take a deep breath, let's start a little slower, and let's scale into some of these positions. That way, instead of incurring these big losses, the 17K, the 9K, the 5K on the way back down, it'll be a much smaller loss, and then we'll scale into positions so that when the market bounces back up, we can still catch these like 11K weeks, these 17K weeks, there it is, 14K. So we could lessen the detriment on the front end, but still receive the full benefit of the bounce on the back end. Now, we're still not quite in a position where we're going to catch anything crazy like a 10 or 15K bounce at this point, but that's because we want to keep in the back of our minds that things can always get worse, right? Looking at a little bit more macro of a perspective, the S&P 500 dropped 2.67% last week. The week before that was basically flat, and then 3 weeks ago dropped 1%. So while that is 3 red weeks in a row for the S&P 500, and we've seen a drop from 412-ish down to 396, which is decently significant, things can always get worse, right? We saw green weeks in the market earlier this year, 2.48%, 2.69, some really, really large green weeks. NASDAQ, we were seeing almost 5% per week at the beginning of the year. But all that to say is, yes, we've had 3 red weeks in a row, but they've been relatively muted. There's nothing stopping the market from dropping another couple percent. And again, this is more of a bend but don't break strategy, and we're still well positioned to catch a little bit of a bend if the market continues to move downwards against us. But we always want to be cognizant of the fact that things can always get worse, and that is how we're going to survive and weather the storm the way that we did the last couple weeks, right? We've outperformed the S&P 500 3 weeks in a row, 1.63, 0.59, and 2.47% over those 3 weeks. So let's keep it going. We've scaled a little bit further into some positions. We'll talk about that a little bit later down the stream. But let's talk individually about some of these. At the very top of what we had last week, you'll see ticker FTCH. This effectively was an earnings trade, but one that we kind of chased down a little bit, right? If we pull up the chart for FTCH, what are we going to see? We're going to go to the 20-day. We're going to see a stock that's been dropping from the 8 price point. It got to like 650-ish, and we said, okay, let's start back in at like 6-ish. But again, we started small. We wanted to scale in. And it moved against us a bunch eventually, but we finally got a little bit of a bounce, and that bounce resulted in us recouping $400. That was really the one trade that was kind of anchoring the week. They didn't have their earnings until Thursday after market, so we really, really didn't know on paper. It was kind of tough whether or not that one was going to pay off or not for us, but it did, so we're happy. Keep moving down the list. I feel like there's enough instances in the history of our trading where we've been the victims of bad luck, so it's always nice to see something go our way there a little bit. EA is one where we've just been riding the wheel. We've been riding the wheel, right? If you look back 2 weeks, when did we start EA? It was 2 weeks ago, it looks like. So we started again, EA. We started that at a 114 strike on February 10th. We pull that chart up. What do we see on February 10th? Let me click out of this. February 10th is right here on the chart. It's gone from about 114-ish down to 110, which is like a 3.5-ish, 3.75%-ish dip over the last couple weeks, which for some of the stocks we play, that's quite frankly just not a very large dip. However, for EA, it's pretty significant. Obviously, if you ignore earnings and look at something like this, it looks a little bit more regular. But all that to say is it's had a pretty decent dip, but we started with the 114 strike puts. We lost 91 off the bat. We rolled them out a week to the 113 strike puts, and it kept dipping, right? We lost 5 more bucks. So what do? We keep rolling down, we roll out. And last week we rolled to the 111 strike puts. We lost a little bit more money, but again, it was only 22 bucks that we lost. So finally, coming into this week, we rolled to the 111 strike put. We didn't roll down, we did roll out, right? We finally got this strike down to 111. We're still at 111. Typically, we like to roll down and out, but at this point, we've lost 118 bucks on the trade. With these 111 strike puts, we could recoup 208 if it goes back up to 111. At that point, the trade will turn profitable. Now, 90 bucks isn't going to make or break the year, but it's been a very low stress trade where I think we took advantage of a good entry point on EA, and now our break-even price is 110-ish, even though we started the trade up here at 114-ish. So we've weathered the dip right here on this one. And you'll see a common theme right there. Right below EA, you're going to see Google. And this one dropped 274 bucks for us, but as always, that's just part one of the trade. We've got a plan B. We've got a part two. We've got a strategy that we're going to be able to execute effectively to make that cash back. Now, 2 weeks ago, we'll remember that we had these 96 strike puts. Google cooperated. We took home a profit of 195 bucks on that, and it turned the trade profitable overall. So what we had this past week was kind of a new cycle of the trade. So we're going to ignore that 195 to be more conservative and kind of explain how we're going to manage these, right? So we start with the 93 strike put. That has a $1.01 premium, meaning our break-even price is $91.99. So it might be easier if we kind of visualize this, pull up Google. It's at $89.35 now. Let's remove all these old drawings. Let's remove this one, and let's remove this one. So if we go to maybe a 5-day chart, because that's how long we've been playing it for, we saw this dip. Remember, we started with the 93 strike. We knew that with the $1.01 of premium that our break-even price is going to be $91.99. So last week, we entered with a break-even price here on the trade, even though the stock was trading up around here when we entered, right? We still had a little bit of a cushion when we entered, but that's why we give ourselves that cushion, right? Because things can continue to move against us. With it closing at 89.35 last week, yes, it's going to be a little bit of a loss, a $274 loss. But what's plan B? Plan B, I guess plan A really is to roll down and out for a credit. But Google had dropped decently below that 93 level to where we weren't really able to do that. So what's plan B? What's step two? The answer is to double down. So for next week, what we have set up, we rolled down the first one. So again, we're only down what, 274 bucks on this trade. We doubled down with an 89 strike put for $1.36 a premium. So if this alone just finishes above 89, all of a sudden our trade has only lost us about 138 bucks. We're going to collect a little bit more of extrinsic on that, and our loss will probably be down in like the 2-digit range, which again is very, very small, very, very muted. What's great about this one though is the fact that we kept that 92 strike put, so we've got a little bit of upside if this comes back. One thing that I don't think we've been doing the greatest job of, I guess maybe to preface this, I think we've done a great job of identifying targets that are going to bottom out and bounce back up. And likewise on the bearish side, I think we've done a great job of identifying targets that are way, way overbought and are going to come back down. But when we identify those, we really only benefit from like the U-turn, or the U-turn down, or the U-turn up, that is. What I want to do a better job of is benefiting a little bit more from that continued rebound, right? So what we've done is we've kept this 92 strike on Google. Reason being is that if we get the bottom right and it runs back up to 92, which again, this is just a 5-day chart, and 92 is roughly in the middle of this price action between 95.78 and 88.86. So the idea is if it runs back up to 92, we've now got a position with a decent bit of, intrinsic value on it, meaning value derived by the position or price of the stock. So we'll make 322 bucks on that in addition to the 136. So even though we lost 274 bucks last week on Google trying to play it at a 93 strike, we're now at a position where if it even just goes back up to 92, which again is lower than the price we entered at, it's lower than that initial strike at 93, just gets back to that 92 level, we're making 458 bucks this week. Netted against that 274 loss from last week, all of a sudden we make 184 bucks on the trade, which is a really, really nice result. It's basically 2% ROR. It kind of translates to $1.80-ish of premium, which on that 90 strike is 2% ROR. So that's a really, really nice potential setup. And again, if this thing keeps dropping, that's all right. We know that our break-even price, if assigned, right, we've got these initial shares at 91.99. We've got a little extrinsic value on the roll, so the break-even comes down to like 92.50-ish, or 91.50-ish rather, and then this 136 a premium gets our break-even around $90 a share. So if this thing finishes at like 2, for example, or it finishes at 90, right, gets back to 90 and just trades relatively flat next week, we're going to make 122 off that. We'll hit max profit on the new entry. That's $258 a premium, which just about nets out against that 274 loss. So again, even though we started a stock, which is a great stock, Google's a fantastic stock to get in. It's way better than a lot of these, more volatile meme stock type things, whatever you want to call them. Again, we started playing this thing at 93, 94-ish. Now we're in a position, if it just gets back to 90, which is like a 3.5%, 4% discount from where we started it last Tuesday. If it just gets back there, we're dead flat. We're even. And if it continues to drop down, we'll take assignment of these additional shares. We'll have what we'll call like a full-size position on Google. It'll be below 90 a share, and owning 200 shares of Google with the basis below 90 is not a bad place to be, relatively speaking. So that's why we, are able to sleep well at night on a 180-day basis. Look, 28.23 on that RSI. We like to look at the 1 year a little bit better, but it's still 37.99. It's getting down there. We know that we like to play things when they get down into the blue, so it could always, always, always get worse. And there's a decent bit of support here at this 86-ish level, which we still have about a $3 gap. So it can absolutely get worse. But again, we take comfort in the fact that we're perfectly fine taking assignment of these. And it's a stock that, one, we think is a good value. We started playing at 94, and if this just keeps going to shit and keeps moving against us, the stock that we started playing at 94 will be ours for like 88, 89-ish a share, which is very, very good on like a 5 to 7 day basis. Which is the duration that this trade will have undergone at that time frame. So that's my little rant on Google. Moving down, we had Wish, which moved against us, and I can't stress enough, this one was kind of annoying because if you actually just take a look at Wish and look at like the big red percentage number, yeah, it dropped 28.7% on us, which is massive. You might say, oh no, we had a bearish or bullish position rather on something that basically got cut by a third. However, cannot emphasize enough, when something's trading for less than $1 and you're trading these strikes that are like 1, the position size itself is so small. it was literally 0.39% of our account. So if you compare that to a typical trade where we're between like 2, 5, 3, 6, 7% of the account, this thing is tiny. So even though it dropped 30%, we only lost $170 on it because we were able to sell one strike calls, which basically had 5% ROR by themselves. So that's a 170 loss. But again, if you go 2 weeks ago, we made money on Wish with a very similar trade where we made 100. That doesn't quite net it out. It drops down to a $70 loss. But look, we had this trade where I think we entered Wish at like 90-ish cents a share, I want to say. Over the last 10-ish days, we entered up here-ish, right on these big green candles. The fact that we're able to enter into a trade like this at like 87 cents and it gets back down to 50 and we've only lost $70 is a great example of the flexibility that we get with this strategy. And while even though things can move against us and they can cause us to lose money, selling that premium, identifying good option selling opportunities with plenty of extrinsic value, which in turn grants you a really, really large cushion, is a way to make sure that even if something does move against you a ton like we saw with Wish, it's not crushing us at the end of the day. This barely moved the needle for our profit total on the week. Up next is Affirm. We stayed a little bit patient on this. We've been going back and forth. We've played this thing both ways. We've played it bearishly when it dips down. We've played it bearishly when it spikes up. We've played it bullishly when it dips back down. And it's kind of back in this mid-range, forming a little bit of a base here at this 12 level. Looks like we've got some additional support at like the 11-ish level. So again, we want to stay careful in these bullish entries. But look, we started with 5 contracts. We know that a full position size would be 10 contracts for us there. So again, half size position, slightly more aggressive strike with 12 being a little bit closer to the money. And last week, this thing actually had a pretty decent 1-week performance, especially when you consider what the market did. Traded slightly red, but slightly red is pretty good result for some of these more volatile stocks when you've got a very, very big red week in the market. So we took home $140 on that, and that was a good example of one where we took profit early. I think we were able to take this, I don't remember exactly when this was. Maybe it was Wednesday morning on the spike, but yes, we left $55 on the table that we would have gotten, but look, you never know what could happen. I think immediately after we closed out, it spiked all the way back down. And while it didn't quite get back down to like the 12 strike that we would have been at, look, you never know. And the only guarantee in the market is what's trading in front of you. What trade can you make and fill to lock profit in? It's not, oh, it looks pretty good. I think it'll be there in 3 days, because you have no idea where it's going to be in 3 days. So taking a very significant percentage of our max profit there, and again, being cognizant of when those opportunities present themselves early in the week, leaves a much less stressful back end of the week. So pay attention beginning of the week, maybe set some price alerts, things like that. And at the end of the day, if you miss it, not the worst thing in the world, because even if you made the mistake of missing this and not closing out early, you'd have made more money, which again doesn't make it smart, but just goes to show you that with this strategy, there's flexibility for entry, there's flexibility for exit. Everything's going to be all right, generally. Moving further down the list, talking about a trade that wasn't okay. Perfect little lead into that one was Intel. And one thing that I want to say, okay, we lost $630 on this, so this one pushed us from a green week to a red week. However, I think the way that we managed this is very, very important, because if you take a look at Intel, we're going to go type in old INTC here. You're going to see a very, very significant drop on a 5-day basis, right? I went from 28.09 down to 24.92 at the low on Friday. But even with all that said, we're in a position to make back money on a bullish position. And with something like Intel, premium isn't necessarily through the roof because it's a more stable stock historically. However, it's tough to combat like a $3 move in a week, but we did. And let's talk about how we did it. So we started with the strangle, right? We knew that if it ran much past 28, we'd probably want to play it back down. But if it got back below this 27 level, it's a decent long-term stock. They do pay a dividend, which got slashed this week a little bit. But that's okay. It's not the end of the world. But the great part about this is you get double the premium, right? Because if we had just opened this 27 strike put by itself, we would have had a 27 strike put with 26 cents of premium. Our break-even price would have been like 26.75-ish. However, since we opened a 28 strike put as well, or 28 strike call as part of the strangle at the top end, we knew that if this was in trouble, this was basically going to hit max profit. So this becomes a bullish position. 27 strike minus 26 cents gives us a 26.75 break even. And we also collected the 26 cents of premium here, so it's a 26.50 break even. Let's do a little bit of math right here. 26.50 break even thanks to this initial position right here. But what did we do when it went below 2650? Because it absolutely went below 2650, this red line right here. We managed by opening another strangle. And the strangle that we chose to open was this 25.5, 26 strike strangle. And thanks to this, we were able to knock 13 more cents off right here. So this month, actually, the better way to look at this is our break-even price on this first batch, right? Then we open a second batch where our price, because it finished below 25.5, is going to be that 25.5 strike minus the 32 cents of premium we received on the puts minus the 13 cents of premium we received on the calls. So we had this initial batch of 500 shares that we were going to get at 26.50 thanks to the first strangle. By entering into the second strangle, either two things were going to happen. It was going to pop back up and we were going to make more money back on this initial position, or two, it was going to continue further down and we were going to get 500 more shares at an even lower price. And going $1.50 lower on the shares you're about to get is a pretty significant reduction in your cost basis. So if we average these two out, we effectively started the trade this past week with Intel at like 28.10-ish, 28.20-ish, somewhere in that neighborhood. And starting with the strangle and then being patient, waiting for the big drop to add the second strangle, we now have shares at 25.77. So the red line, our break-even price, goes from here down to 25.77, which is here. And now since we've been assigned those shares, great news is we could take it even lower, right? You'll see that we have 1,000 shares for Intel going into next week. And again, this is 25.14 because Intel was 25.14 last week. Our constructive break-even price here is 25.77. But if you're wondering how the profit tracker works, this is 25.14 because we've effectively taken the dip to 25.14 as a loss through here and here. So that's how the math works on that profit tracker. But again, we're able to sell 25.5 strike calls for 28 cents. So we now take this basis and we subtract 28 cents from it. And we're now rolling into next week with a break-even price of 25.49.5, which is now down here. So in roughly like 4 to 5 days, we took a stock that, is potentially a decent entry. It's had a big drop due to earnings, but is coming back down to a level of support at 25. We started that thing at 28. We now head into next week owning the stock at $25.50 a share. And again, that is below the current price. However, what that does is leave a little bit of upside for us. So we know that no matter what, we're getting that 25.5 strike call premium. So we're bagging $280 of profit off that no matter what. That protects us, one, from a 28-cent dip in these shares next week, but two, with that strike of 25.5 sitting above the current price of 25.14, we also have upside of 25.5 on these shares. So we can recoup $640 on this. And wouldn't you know it, netted out against last week's loss, our big loser turns into a $10 profit, which is basically netted out by commissions. But point being, our worst trade from last week, where we saw Intel drop like this, we effectively make all that money back if it just gets to this red line right here. And again, if it continues to drop from there, we could potentially add 500 to 1,000 more shares, but we don't want to do it right away. Very, very important, because if it breaks through 25, it could get down to 24. We really want to have this trade get away from us before we start to allocate a little bit more capital to it. So let's not instantly jump into a strangle, because it could definitely be tempting to look at Intel and say, hey, we've got the shares at 25.5. What if we sold, 10 more of these for 20 or for 40 cents, and then knocked our break even down to 25.10, and that's below the current stock price? Yes, that's great, but if Intel goes to like 24, you don't have a problem with your initial shares, and two, you have a problem with these puts that you sold. So you don't want to have two problems off the bat next week. We want to have one problem, which is our shares, which we want to bounce back, and then if it gets worse, this is plan B for the coming week. But we'll hang tight with that and let that play out. But that's a good example of how using a strangle can kind of help you in both directions a little bit. And one important thing is, when you sell a strangle like that, you've got cash secured puts, assuming that you could take assignment on the puts, but you also have these calls which are naked. So we don't want to open strangles on everything and just go buck wild on them. What we want to do is make sure that there's, no crazy short interest, right? We don't want to look at a stock like AMC and say, oh, we should sell a strangle on this, because this thing can fly up on you way, way, way quickly. If you look at something like Intel, much more muted price movement. The size of these candles are much smaller, much more manageable. These are the types of things we want to sell strangles on. Now it's something like AMC or Bed Bath & Beyond, where you've got these huge candle wicks because there's massive price movement. Avoid that. Stick to this. manage accordingly, and you're going to be okay. So going down XSP, another good example of a strangle where we jumped in, it moved against us, right? If we pull up the XSP chart, we go zoom into like what, like 5-ish days? 5-ish days should illustrate last week pretty effectively. We'll see, look, this was our initial range that we needed the thing to stay inside of. It opened red on Monday, so we were already kind of up against it a little bit, but it moved out of that range. Our break-even price wasn't 404. These are drawn in the wrong spot. These are old. Our break-even price initially was 402 minus 319, so our initial break-even was like 399. So when it got down below this level, and one important point to make here is this 399 level, yes, it got breached at one point on Wednesday morning, but we don't want to immediately jump back in because really, once it hits that lower leg, there's two things that can happen. It could bounce back up like we saw happen by Thursday afternoon. Before close, this thing was almost going to take home max profit. But then option two, as we saw on the gap down Friday morning, is it can get worse. So you don't want to just go crazy, get too excited, blow all your cash and double down right off the bat. You let it get there and then just keep a little bit of an eye on it and keep your eye out. If scenario one happens and it pops back up, you're good to go. Don't touch it. Wait for things to get worse. And then what you do, you scale in like we did with this 226 of premium we got on the 396 401 strike call. And that 226 nets out against that 266 loss. We lost 40 bucks on it. So it moved against us. It moved outside of our range. You know, the market had a pretty wild week. S&P 500 was down like 3% at one point, which is a pretty decent move for 1 week. But even though we had that move against us, we managed the position accordingly. We stayed patient. We waited until it really got down below our break-even price. That's when we added that second strangle. And that caused us to manage our losses, right? We're going to have losses sometimes. We're going to win a lot. But when we lose, it is so important. And I say this every single week. We need to manage the size of the losses so that one loss doesn't crush us. And overall, these XSP strangles are working great. Yes, we lost 40 bucks on this one, but 1 week ago, we made 223. 2 weeks ago, we made 215. There you go, a small loss of 58. Then you've got some more management that net out to a small gain, but we've just been moving forward. We've been doing these for about 3 months now, these XSP strangles. And we've returned 19.06%. And again, that's conservative, assuming collateral of 8,000 bucks, right? You can use this instead of using XSP. You could use MES. The collateral is only like 2,000 bucks, and then we'd be looking at something like a 76% return in a 3-week period. But again, that's really just kind of semantics and how you look at it. We take the conservative approach. I don't want to get too clickbaity with this, but again, 19.06% in 3 months for what we're doing with the XSP. That's been fantastic. And volatility is ticking back up a little bit, which is nice because we're able to get some wider break-even ranges, right? So if we take a look at how we're using this strategy for next week, let's actually go ahead and throw this in here. 224. It's going to be -1. And oops, I didn't type the 1 in there. But again, what do we have for next week? We've got a very similar strangle set up. We've got a 392, 402, and this is 10 wide, right? Thanks to the volatility ticking back up, we're able to get that 350 credit on 10 wide. Where you look at last week, we also had 10 wide, but it was a 319 credit, right? So we get a little bit more premium on that same width right there. So we've got that. Let's go throw this into this part of the spreadsheet. This is what we're looking at. The credit that we got is going to be, where to go? 348. We drag these formulas down. This just need to be 0. This is not going to be yellow anymore. And there you go. We're now in a position where we can bag 348 bucks, add to this, and potentially if it finishes between 392 and 402, we are going to be looking at 23.41% in a little over 3 months since we've been starting these. But again, just keep an eye on it. Not much to do, and let's to visualize how effective this is, right? Let's remove the old drawings really quickly. Let's zoom back in a little bit. Come on. So what do we have, right? It finished at 397-ish. Our legs are 392 and 402. So we're going to hit max profit between here and here, which you may say, HT, this is not that wide of a range, you know? But one, it basically stayed within this range for the last 4 days. And two, we know that that's just our max profit range. Our break-even range itself is going to be 402 plus the 348, so like 405.50, which is all the way up here. And then our break even on the low side is going to be 392 minus 348, so like 388.50. Little mental math right there. Hopefully that's not too bad. But there you go. So we make max profit of 350 bucks in here, and we make money to varying degrees between here and here. And again, once these get breached, don't jump at it right away. All right. Plan B is to add another straddle or strangle rather, but don't do it right away. Let it get worse because things can always get better and it'll come back and you'll be like, okay, I didn't have to lift a finger. We're good to go. But things can always get worse, and we just want to be careful in case they do. It's a volatile market. Don't get crushed. But again, very, very wide range for profit for the coming week. So we can go all over the place. We can go up, we can go down. We could have a plus 2% day, a minus 2% day. But as long as we just kind of come back to home base, that's going to be the easiest 348 bucks you've ever made. We're going to continue to build on these, approaching the 2K profit mark so far. And again, you could easily size these up. Like if we wanted to take a little bit more of our position out and maybe like 2x, 3x, 4x the size of these, if I wanted to 4x this, we'd be looking at like 7,500 bucks of profit, which is, obviously, look, we could play that hypothetical game, which probably isn't the most objectively fair way to look at it. But, if you want to dedicate a little larger of a percentage of your account, I want to scale up on these, but I do want to wait until one goes like terribly wrong because look, I know that it's going to happen eventually. One week we're going to have like a +4, -4, -5% week, and it's going to be like, oh, that sucks for what we did here. But then I'm going to probably scale it a little bit further after that. But for now, we're going to keep this up, and if it keeps going well, it keeps going well, and we never have to worry about a thing. But at any given point, the big loser is around the corner, so we don't want to. We don't necessarily want to get too overzealous just because we've had a few months of success. But that's nothing too crazy to talk about. Palantir, I think, was managed really, really well. We started with the 8.5 strike puts. We know that with, let's pull the calculator up here. We can kind of run through this one. Because if we look at Palantir, look, it dropped decently on us, right? PLTR. Pretty significant drop in the last 5 days from 971 down to 782 at the low. But we played a bullish position on it. And even though it dropped like 20-ish% during the week, we're just fine. So how is that? The answer is we started with the 8.5 strike put. We sold that for 21 cents of premium, minus 0.21. So off the bat, our break even's 8.29. So what do? You take the hands off the wheel. You sit back, you watch Palantir. If it stays above 850, boom, that's $100 for you. Go get yourself a nice dinner on the weekend. But if it goes back down, you wait. And then if it breaks 829, remember like the XSP strangles, you wait again. If it gets better, perfect, you're making money. If it gets worse, then you start throwing a little bit more capital. It got worse, so we sold some 8-strike puts. So again, you definitely want to have a little bit lower strike. Keep it out of the money when you scale in because things can always get worse. But we got 11 cents of premium. So if you subtract 11 cents, now we've got an 8.18 break-even price. It kept dropping. It kept dropping, which is fine because if you get assigned these shares, you're going to have a break-even price around 8. You kick the can into next week, but it bounced back up. It closed above 8. So the great news is we used our double down. However, our double down position expired worthless. So now we get to roll the initial position into next week, right? We've got these 8.5 strike puts, which we rolled down to 8 strike puts. And we still have that double down in our back pocket. We could add 5 more contracts because our double down from last week expired worthless. And look, we lost 65 bucks on it last week, which again is nothing. We're now in a position where if Palantir stays above 8, we get 115 next week. And even though this thing dropped like 20% on us, we're taking on 50 bucks. And again, it's not a massive number of cash, but the idea is if you just, even if it's just 50 bucks, right? The big winners we talk about for 2 seconds here, right? There's a lot more subject material and ways to learn from the losers. But even if you turn a losing trade into something as little as a $50 profit, if we don't lose, we are going to win and win a lot. Focus on turning the losers into winners. Don't get too greedy. If you got something move against you and you could have a position where, hey, if it stays flat, we're now turning the trade green, we take that. That's exactly what we did with Palantir. Gold, very, very similar. We started with a 16.5 5-strike put. Oh no, it moved against us, right? It kept going down, and we love staying bullish on this one. Why? Because if we go to the 1-year chart, take a peek, 25.33. That is a very, very low RSI. Last couple times we've seen it that low. It hasn't necessarily shot back to the moon or anything, but it's leveled out a little bit. And again, with this strategy on a week-to-week basis, consistently collecting this premium, just leveling out is plenty for us. And again, it happened back here. You saw a little bit of a spike. So what do? We stay in it. We stay bullish. We started with the 16.5 strike put. Let's bring the old handy dandy calculator up. We sold it for 20 cents a premium, 16.3. It kept moving against us. Oh no, but what do? We use plan B. We use that cash that we keep in our back pocket. We sell 13 more cents a premium. So now our break even is 16, 17. But we didn't necessarily want to take the entire position in the next week. Why is that? Because if we take the entire position in the next week, we don't necessarily have a plan B. We get down to like plan C, which still exists, but I like having plan B in the back pocket. Sounds weird out of context. But we close this thing out to lock some profit in. So we paid a 5-cent debit, so it knocks the break even back up 5 cents. So 16.22 is the break even we go into next week with. We get 500 shares assigned. Take a look at the option premium. You've got 16 strike calls for 24 cents. Look at that. Break-even price is $15.98. We've got upside to 16. We can now bag a $120 profit if it holds above 16, which nets out against the loss last week. Look, it's only a profit of like $10, but one, it was a losing trade from last week. Two, we don't have to take the full position in the next week. And three, on a 1 week basis, it'll make us some cash. So looking very, very good from that potential perspective there. And then really not much else to talk about. Lyft, I think, is a great example of taking profits early. We made $75 in like the first couple hours that we entered into that trade, that 10.5 strike put that we sold. And you'll see that if we kept holding that into the end of the week, it dipped pretty hard below 10.50 and we would have lost money on the trade. So yes, it's easy early in the week when it's like, oh, a Lyft is 11.36. We could take $75 of profit, but we leave 50 on the table. How do you balance the idea there? And, guaranteed profit above like 50, 60% of total max profit on like a Monday or a Tuesday, just don't even think twice. Hit the close button, take that cash, go spend it on something. Go, I don't know, whatever you're interested in, go spend the cash. Doesn't matter, or reinvest it. Because we're doing Lyft again next week and we're going to try to make even more. But the point there is we took profit and it was a great example of when, if we hadn't done that, it would have turned a winner into a loser. We hate that. That's like the worst sentence in investing in what we do. But again, since we took the profit early, we see that there's a big slide and we take advantage of that slide to jump back in next week. So even though we left, $25, $50 on the table last week, we're now in at a lower strike for next week where we can make $125. So there you go, a $75 difference there. Appreciate the comment, Nye, in the YouTube chat. Appreciate you tuning in every week as well. Definitely recognize the name. But yeah, that's a great example of why we want to do that. And you might say, oh, we could have made more. What's the strategy, right? We're not trying to knock it out of the park in 1 week. We want smaller, consistent, smarter gains, and those are going to compound over time, right? We're focused on running our own race. Look at our profit balance. It's been a volatile year in the market. Look at the NASDAQ and the S&P 500, but you wouldn't know that if you take a look at our account balance because we're starting small, right? We're being smart about where we get in. We have plan B. We keep cash in our back pocket. We scale into these trades. We try to wait and be patient for good entries, and we take profits early. And this is what that looks like. It maybe is annoying on like a 3 or 4 week basis if we've only made like $1,000, but I can guarantee you that looking back over a 4 week basis where you've only made $1,000 is miles better than looking back as we have previously on a 4 week basis where, oh no, we have a really big hole that we need to climb out of, or, oh, we lost 3,900. We try to get it back and we're down $7,000 and we need to make that back. So you could have 2 great weeks after that and still be $5,000 in the hole. So we just don't want to dig these big holes for ourselves, right? Don't dig the big hole. Be smart. Boring profit is good profit. You might put yourself to sleep. And I got to be honest, if you're putting yourself to sleep during the week, that's like as good as we can ask for, right? A boring week is a good week for us because our heart rate only spikes up a little bit when things are moving against us. JRA, appreciate the comment as well. Thanks for tuning in tonight. But that's about all we got to talk about, right? We got in on you, which was solid. We got in on Lucid as well off a post-earnings dip. And this is another little pattern we like to look for. Sometimes like volatility dries up a little bit in the market, but you'll always find different places to find volatility. It's always out there somewhere, even if it's not in the broader market. Pre and post earnings moves are a great way to find that. Lucid went from $10 a share, dipped down, and then opened up at like 875. Big red candle, and I think at 850 is where we entered into this thing, right? So we started at 850, sold an 8 strike put for 12 cents a premium. So we said, look, the thing's at 850. Can it keep dropping? I know no one can like actually respond to me, but yes, always it can keep going down. But it's you're kind of playing the numbers game a little bit, right? And if we have to take 1,000 shares of Lucid on at 788, I think we're okay with that. We can die on that hill because we have more room to scale in. But point being, implied volatility stayed elevated for a slight short period of time right after open here, right? It doesn't all go away, right? It dries up a ton, but doesn't all go away. So if you take advantage of these big dips and can kind of find a price point you're comfortable investing at, there you go. We looked at our watch list for 2 seconds. We saw that we placed the trade, probably 30 seconds of work, and we get 120 bucks off that. So if you've got something on your wish list for 120 bucks, 30 seconds of work will buy it for you. Jeff, appreciate the comment as well. Love it. Chat's popping. But I think that's about all we've got to talk about for this past week. Yes, it sucks to lose 366 bucks. I just said you could buy yourself something nice with 120. We actually didn't even make 120. But relative to the market, our goal is to outperform. Because look, if we can't outperform the S&P 500 and Nasdaq, what are we doing with all this? We're just wasting our time. We'd be better served just buying and holding. But since we've been publicly tracking our trades since July of 2020, which I think is plenty of a sample size at this point, admittedly, around this time frame, I wasn't so sure. But we continue to improve our strategy every single week, every single month, every single year, and it's been paying dividends. We're outperforming Nasdaq by 140%, and the S&P 500 by 124%. So we're going to stick with that, just stick to our game plan and run our own race, and I think the rest will take care of itself. Good comment from JRA about selling puts and wheeling nothing but TQQQ and TNA, since those are getting discounted when the market is overbought. I love the TQQQ trade. And I think I kind of slurred over the last 2 Qs there. TQQQ trade. There we go. We're close to the hour mark. This is normally when I start just stumbling over my words. We haven't played it since week 1, I don't think. But when we played it, boom, 330 bucks a profit. But we really want to be careful. And we played it the week after that too for even more. So we made 1,500 bucks in 2 weeks on TQQQ. And I think it's a great trade when the opportunity presents itself. So I don't think we're quite there. I love the idea of getting in and using it on the dip, but I don't think we're quite there. Reason being is if you take a look at the 1 year, and good Lord, my nose is itchy right now. We're not really in that oversold category yet. I mean, if you look at the 1 year chart, right, through ranges from 62 down to 16.1. And for those of you who trade and follow these leveraged ETFs, you know that they can move a ton, right? They could fly, they could dip, you could catch a knife, you could catch a spike, etc. But the closest thing that we have to being a sure thing for entry, and again, there's never such thing as a sure thing, but we could make educated guesses in the market. I love getting in here when we're close to 30, and we're not there yet, quite frankly. We're at 44.65. You look at even QQQ, again, 46.40. S&P 500, 42.20, a little bit lower, but again, I don't like to get into these leveraged index plays until we really start to sell off, and we're just not there quite yet for me. And the reason being is because if we start selling off and I'm in TQQQ, that TQQQ position is going to be a loser. And you know what else is going to be a loser? The rest of the bullish trades that I have in my portfolio. So we'll ride the bullish portfolio. 1 year RSI on the S&P 500 is below 50. We're perfectly happy to be going bullish with that. And we'll ride these trades out. And if they move against us, we'll keep playing defense the way we have. And if they continue to move even further, this will get down near 30, and then that is when we start to scale in and jump in. And again, we don't want to throw all the cash in at once. We scale in, but very effective way to catch and play bounces in the market. But again, yeah, that was last week. Pretty boring when your account balance is $300 less than you started the week with. Annoying, objectively. But again, keeping our goal in mind. We accomplished it. So looking into next week, a lot of it is a continuation of what we've already talked about. We've got lift, right? We stayed patient. We got in at a lower strike and can recoup even more money than we left on the table last week. We talked about that. We've got Unity, which we sold for a 27 strike put. And the great part about Unity is, again, this was another one we played last week, right? We played it at a 30 strike. which is fantastic. We made 165 bucks. And what did we do? We took our profits, right? We closed this thing out for 10 cents. And what did Unity finish the week at? 29.61. And in fact, on Friday, it got all the way down to 29.01, meaning that this thing that we closed out for 10 cents was worth over $1 at one point. So we would have been looking at like a $250 loss. So even though looking at something like a 165 gain, might not jump off the page, the difference between a 165 gain and like a $250 loss, it's like $400-ish. That's pretty significant from your P&L perspective. So we stayed patient, entered on the dip, took profits. It dipped even further. And then on that further dip, we get back in, but we don't want to use that same strike, right? We go down to next week, start with that same half-sized 5 contract position, 51 cents a premium. So if this thing keeps dropping, and which it could, and we would be able to, in part, battle against that. Our break-even price now is going to be $26.99, which is all the way down here. All the way down here. So we now have gone from a trade where, we were kind of battling around 30 to basically being in the same trade for more premium, right? We'll make $255 at max profit on this one. And now our target is way down here. So if we look at like a 10-day basis, this thing's starting to sell off. We go to a 1 year. It's at 39.53. Not quite oversold, but again, that's why we start with the half-size position. That's why we start way out of the money. But so when it does get down there, we can scale further in and really play that bullish thesis. But that's the idea behind Unity. Intel, we talked about that. We used 2 strangles to average into it. It was a stock that started at like 28.20-ish last week. And we now have a break-even price of $25.49. So very, very good 1 week process on that. And look, Intel's not going to go bankrupt tomorrow. Can it keep dropping? Absolutely. But this thing pays a dividend. We're going to be okay. There's a decent loss on paper. It's not $1,000. It's not even close to 1,000 yet. But we'll just keep riding the wave. We can make $640 back on it this week. Even if it doesn't move off 25.14, we're collecting that premium. $280 a call premium. And that's where that sits. Palantir, not a crazy one either. Smaller position, but look, $115. And again, the idea, we talk about it every week. We don't want to crush it with one trade, but we want to have a lot of smaller trades which add up to a really, really nice weekly number and get above that 1% profit target on the week. Gold, same thing. We talked about that. We got to maintain that half-size position. We love to look at RSI. You take a look at gold. I mean, this thing is 25.33. That is a money entry from an RSI perspective. Affirm, talked about that one as well. While we did play a 12 strike last week, and we like to go a little bit lower on a week-to-week basis, Affirm actually was slightly green last week, I think, so I'm okay with rolling the strike up like 50 cents. And again, we got 39 cents of credit last week. This week we get a credit of 48. So our break-even price is going to be 12.02. We take a look at that on Affirm. We go to like 5 days, 12.02, all the way down here. The bottom, even with how volatile Affirm was last week, didn't even touch this price level, which of course is not to say that it won't, but to say that we're making a smart, educated guess at a level that it hasn't touched in the last 5 days. This is a 5-day trade. Keep it going. Futures right here, plus 0.22%. Hopefully that's a good sign of things to come this week. EA left ourselves some upside. Google, we left ourselves some upside. DraftKings, I couldn't stay away. We got our shares called away at like $12.50 or something super low. And then, of course, it runs up to like 20 after we spend an entire calendar year fighting it. But now that it's fallen from 21.62 back to 18.15 on a 20-day basis, look, we're a little bit more oversold. We could start with that half-size position at 17.5 for 33 cents a premium. That will set us up right here at 17.22. Not the worst place in the world to be right there. And then we have the XSP strangle. And there's one more trade that actually filled, which I didn't put in here. And it's minus 10 ASTS 3.3 5.5 6 strike puts. I believe we got a 20-cent fill on those. And what's really interesting about these is that we're using a spread instead of selling cash secured puts. So why is that? And I think this is a really, really great way to play it. I'm actually really excited this filled and is working out the way that I want it to. Because look, if we wanted to just play a pure old cash secured put, we could have done that for 40-ish cents. We could have done that. We would have had a 5.60 break even price. But with ASTS, what you'll notice is there really isn't a lot of premium the further you go out of the money. So when you see a situation like that, in theory, right, we can lose 100% of our investment on a cash secured put if it goes to zero. But with the stock like ASTS, which one has demonstrated some pretty good support around this 580-ish, 590-ish level, which coincidentally 580 is right where the break-even price of that trade is. They're a smaller growing company. It could be a little bit volatile. They're susceptible to potentially issuing an offering to raise cash or doing something like that, which overnight would crush the stock. Like, I think PGY was a good example of that, which we have to really zoom in. And I zoomed in on the wrong part. But yeah, they went from like 7 to like 2 in a day, which I'm not even remotely saying something like that's going to happen to ASTS. But again, this thing's not a stranger to big red candles. So if we could benefit from a bullish position, because I do want a bullish position on this stock, yet at the same time, save ourselves a little bit from a big potential dip, which could be on the table, we just buy that 5.5 strike put to hedge it. So even if ASTS goes to zero, the most thing this thing's going to be worth is 0.5. We lose $300 instead of losing like multiple thousands of dollars. And if it continues to drop, we could do what we do with like the credit spreads. If you'll remember, sometimes when things move against us, we take the top off, so to speak, or we close that long option for a profit. So like if ASTS dropped to $5 a share, right? These 5.5 strike puts that we purchased to hedge, those are going to make money, and every cent you profit on these is a direct reduction to your break-even price. So you could cut those loose, let the 6 strike puts ride, the short puts that is, and have an even lower break-even price with even more upside on the trade. So that's a setup that I think I'm really excited about. Good question from Jerry. Have we stopped the IV reversion trades, or are they just less frequent? We have not stopped them. I think the answer is just that they're a little bit less frequent. We've been messing with some scanner stuff to try to pick them out a little bit better, because with our previous alerts, we would get a lot of just a lot of false positives. It was clogging things up. But for example, a couple weeks ago, right, Lucid. I know we talked about Lucid, but we saw this big spike on Lucid. If we go to a 20-day, we should see it, boom, just within the 20-day window, where it went from like 917 to 17.8, and we were able to take advantage of that. So if we go back up to Lucid, we will see ... Surely it wasn't that long ago. 127. There we go. We sold 8.5 strike puts, right? Same exact idea with the IV reversion. You wait for good news, and the news here was that there was going to be a potential buyout. So it shot from like 9-ish a share to 17. So you wait for good news, big spike in implied volatility. We had both of those, and you try to sell around the base that it took off from. We knew that the base was 9, and we were able to go even lower at 23 cents. And the great part about that is that when you sell in 23 cents of premium, on like an 8.5 strike, it's like a 3% return right there by itself on something that's way down here. And yes, it did make it all the way back down, which is why these are quick ins and outs. You don't want to hold this thing for like 2 or 3 weeks. You want to get in. You want to wait for the IV to come back down like this, and then you get out of the trade. You take your money, $270, and we keep it moving. But you know, truth of the matter is just there's just been less opportunities. But trying to keep an eye out for more of those. We absolutely want to keep doing that, because what I love about them, and I think what I say that I love about them a lot, is the fact that even in a volatile market, these things work really well because they're relatively disconnected from the overall market, right? If the S&P 500 is going down like 2% a day and Lucid's up at 17 and your break-even's down here, look, it's not going to drop 50% a day because the market goes down. Price movement's going to be much more tied to some more trading type activities. Yes, it'll be volatile, and you could run into a situation where the market goes up and those go down, but point being, it's disconnected, so you don't run general risk of the market decreasing. But yeah, trying to keep a better eye out for those. We're definitely working on doing something like that. But this is what we got for the week, right? At kind of a base level, and I haven't updated these formulas yet, but we're going to be looking at a little bit above $2,000 of profit at base level. What does base level mean for those of you who might be newer or watching the replay? If stocks go neither up nor down, which is probably the most objective way we could evaluate a trade, this is how much money we're going to make. So if nothing moves, we don't have to press a single button. We don't even have to open our brokerage this week. And if everything finishes at these prices, which it won't, but this is how much we're going to make. And the great part about this is things have to move against us, essentially in this magnitude, for us to lose money that week. So we go into it with this. We manage how we need to manage. If things move against us, we've got plan B. We've got step 2, 3, 4, and beyond. We've got a lot of cash in our back pocket. We can continue to enter into these, but that is where we currently sit. And we're right about at the hour mark, so I think it's probably a decent place to wrap it up a little bit. So if I go back to full screen, boom, we've talked about last week. We've talked about the last couple weeks, really, where we've held steady against the market. So even though the market's volatile, you're going to see a bunch of tweets where people get super bearish and are like, oh, this is the crash. It's going to be worse this time. We're holding steady, right? Because even though the market has dipped a little bit, it can absolutely dip much more. So while we have held our ground, we don't want to have all of our chips on the table quite yet. We want to reserve some, right? We carried half positions into next week to the extent that we could, which has been very, very nice. And I think we're going to reap the rewards of if we see another further dip and people start to freak out because then we've moved like 5, 6, or 7% down in the market. We're still going to be looking pretty good, right? And I'd pull the chart back up if I could, but again, smooth, consistent income generation. Some weeks the market's going to go like this, and you're going to be like, oh, we're down here. But again, you'll have some weeks like the last 2 weeks where the market does something like this, and we're cruising. The tortoise versus the hare, and we're just going to stick to our game, run our own race, and take advantage of the market as it presents itself. We're not going to trade just to trade. We're going to manage what we get in on. We're going to keep an eye on RSI, different support resistance levels on stocks and the overall market. And if we do our research, do our homework, the rest is going to come together. But that's all we got. Thanks again for tuning in. We'll be back same time next week. I don't really know what else to say. I don't think I have much more to say. Hourglass-trader.com if you want to join HT Premium. That's right, the self-promo. If you want to join HT Premium, it's going to be right in the center of that, hourglass-trader.com. There's also going to be a big purple button in the middle to join our Discord server if you're not already a part of that, where you could chat live with us throughout the week. And while we do have the premium channels at the Discord, number one goal here, which is why we do the free weekly live streams with game plans, number one goal is education about the strategy to pull people away from the garbage, get rich quick stuff, because you're not going to get rich quick in the market. You can get rich quick in the market the same way that someone could get rich from the lottery. Can it happen? Sure. Will it happen? It's probably not going to be you. But this is a much surer way. While it takes a little bit more time, it's a little bit more consistent. And I guarantee you, with patience, we are going to reap the rewards of what we've put forth. But that's all we got. Till next time, this has been the Hourglass Trader, where as time passes, we make money. And hopefully we will see you guys again, same time next week, with more money in our accounts than we have right now. Thanks again to all of you who tune in live and to those of you who are watching the replay. And now that is officially all I've got. So I'll see you guys later.